Something has changed in the economy, and most people can feel it. Investing feels harder. Prices feel higher. Markets feel more unpredictable. Strategies that worked for years suddenly feel less reliable. That feeling is real. Because the old economic era is ending, and a new one is beginning. If you understand what is happening now, you may be able to position yourself ahead of the crowd. For more than a decade after the financial crisis, investors benefited from one of the easiest environments in modern history. Interest rates were low. Money was cheap. Inflation stayed quiet. Central banks often stepped in when markets fell. That created a powerful cycle. Stocks surged. Real estate boomed. Growth companies thrived. Risk-taking was rewarded. But that world has changed. Today, borrowing costs are higher. Inflation is more stubborn. Governments are intervening more. And global tensions are reshaping trade. The old playbook no longer works as easily. Many investors still use strategies built for the last cycle. That creates frustration. Because in the new environment, markets care more about profitability, cash flow, debt levels, pricing power, real demand, strong balance sheets. Speculative stories can still rise, but they often fall harder now. Easy money used to hide weak businesses. Expensive money exposes them. Some people think inflation is over. But everyday life tells a different story. Housing costs remain high. Insurance costs are rising. Food prices are still elevated. Energy prices can spike suddenly. Services remain expensive. This matters because central banks now face a trap. If they cut rates too fast, inflation can return. If they keep rates high too long, growth slows. That uncertainty creates volatility. And volatility creates opportunity for prepared investors. One of the biggest changes many people miss is this: governments are now steering money flows again. Massive spending is going into semiconductors, defense, energy security, infrastructure, domestic manufacturing, critical minerals. This means investors can no longer ignore policy. Entire industries may benefit from government priorities for years. Sometimes the strongest tailwind is not hype, it is political will. Most people think artificial intelligence is only a technology story. It is much bigger than that. AI is increasing demand for data centers, advanced chips, cloud computing, cybersecurity, power generation, transmission grids, cooling systems, industrial automation. That means AI could create winners far beyond famous tech companies. Some of the best opportunities may come from the businesses supplying the boom, not just the companies receiving headlines. Here is something many investors are missing: AI needs electricity. Lots of it. Massive data centers require enormous, non-stop power. That means utilities, natural gas, nuclear energy, battery storage, and grid infrastructure could all become major parts of the AI story. Tomorrow's tech winners may depend on yesterday's power companies. That is how new cycles often work. In this new economy, smart investors are increasingly watching companies with strong cash flow, manageable debt, essential products, pricing power, exposure to long-term trends, good management, reasonable valuations. This does not mean growth is dead. It means quality matters again. And quality often outperforms when conditions get harder. Several themes may stay important in the years ahead: AI infrastructure, energy security, utilities and power demand, domestic manufacturing, dividend-paying blue chips, defense technology, critical minerals, automation. The next winners may not look like the last winners. That is where many people get stuck. The economy is not broken. It is evolving. We are moving from cheap money to expensive money. From easy globalization to strategic competition. From speculation to selectivity. From endless liquidity to disciplined capital. That shift can feel uncomfortable. But for investors who adapt early, it can also be a huge opportunity. Because when the rules change, so do the winners.